Good day, everybody. Brian here, quantlabsnet.com. Today we're going to talk general trading, and I've spent a couple of days now regarding the rhythmic data I have access to now. I've talked about that enough, but I want to show some of the patterns I'm seeing with futures data and some of the big advantages I like with futures. So this is today, October 30th, 2025. You can see here what's been going on in the U.S. markets. The markets are down. We're past the stocks reporting season, and things are looking down. So you can see here, this is why I like Amazon because of the just broad global perspective you get. So you can see just everything's kind of down, including crypto. I'm gonna talk about crypto in a little while. Um, Very important to talk about that as well. And interest rates, commodities, everything's down there. If you haven't seen my article on why gold and silver have dropped last week, uh, that is not an organic reason. It seems to be that was kind of, we'll just say, prearranged. And then we have currencies. So that's where we're at right now. And let me see if I can find it. So I put up an article here on my website called quantlabsnet.com to get access to this group, it's a Quant Finance group. You just try out this membership, and I am positioning this membership now to more do analysis on what I think of this and what I think of that. Let the AI write it, which does a pretty good job. But here is a very big reason why crypto is not doing as well as you think it should. You might want to read that if you want to try out the membership. And it's very good at explaining it. I'm not going to go into details here. There's also kind of lots of news, but just so you know, Glassnode, one of the watchers of Bitcoin, because Bitcoin's been going down lately, they predict it's going to go down to 88,000. Now, 88,000 sounds good, and yeah, crypto may bounce back. We'll go into the crypto. Okay, so pretty well everything that's working in the world of crypto right now is everything's down. So if I go into crypto or sorry, Bitcoin, the chart, if I can do that, anyways, crypto's down. And that's coming in from a high of about 120. So from my perspective, let me just do a 6 month chart. Right here from that high, it's kind of range bound lately, but it could decline and then go into a long crypto winter. There's a different approach when it comes to crypto, but that's something I'll talk about afterwards because everyone's asking crypto, Bitcoin, and whatnot. One thing I will say about this membership that I led into, two coins you may want to look into that because of gold has pretty well been spooked. I'm seeing Monero and Zcash are getting a lot of attention, a lot of return. So that's where people are going potentially to hide out because it's private coins. So just put that out there. So right now the time is 6:33 Eastern Standard, my time, and you can see here by volume, this is what matters. Volume is what drives the futures market. Okay, you can see here when you have certain um, different assets, we'll call it. You can see the volume drives everything if it's on the short or the long. Okay, so in this case we have soybean. Corn I'm going to talk about, and that's one of the higher volume, higher traded by volume, and which is liquidity as well. So there's that. So if you go back into my groups here, and you ever become an elite programming member, very small amount because it's now very expensive. I'll be sending out an email on that. But you can see here, I put out some very fascinating articles. Now, this is from my highly advanced AI. I'm going to go through some of these. So let me just start from the bottom here. I think I did 8 yesterday, and this is going to go over some of the examples of what is traded and why and how they go about with their standard ways to take advantage of these trading opportunities. So last week I put out gasoline, RBOB, and oil. So some of the other ones, if you watched my last webinar, these are some of the other highest, strongest momentum driven instruments that are going to make some waves in the futures market from this day forward. Again, October 30th. So if you are in the markets right now, equity market, stock market, um, it's fine when you have the momentum, but I want to show you through this article or through this video and how some of these firms trade them. So first, I'm going to talk about ES, which is probably the most popular out of there. So this is when I'm talking about quantitative and HFT firms. So these are shadow entities that are involved with very unknown practices. So some of the methodologies that can be used, they have all the data modes because if they are trading, well, they are trading through the CME, Chicago Mercantile Exchange, they have access to data that we, the retail crowd, don't have access to. They get a lot of trading edge from that data, and we're going to go through that and how they go about doing it. So there's data modes, micro algorithms, options for flow, futures royal arbitrage, spoofing. Spoofing is the big one. Spoofing layer momentum ignition, dark pool infiltration, indication of interest sniffing, volatility surface prediction, regulatory arbitrage, machine learning models that predict CME order book fatigue, and gamma scalping. So these are techniques that you may never heard of. What I can do is with some of these details, I've done this before. I showed it in my last webinar where you can take this analysis, feed it into a coding LLM. I'm sure you know which one I'm referring to. Out of San Francisco. Oh, did I just say that? Anyways, with that, you can turn that into code. And as I said before, you can also use a front end like Python's Streamlit application, and you can compare with back tested uh, real. In this case, I have real live market data for whatever I'm trading. So in this case, it could be let's say the CME, sorry, the ES. So here we're going to go through 10 different methodologies. Now, one thing that needs to be understood among all this, let me just get over to the folder that I want. I've gone very deep with this. I have now, uh, I have done 3 days of analysis on this. Okay. So I take this very seriously. So what I've got here is I've got my folder of all these different folders, sorry, files of all the different contracts that are available for November, December this year. One of the things to take away from this, that's very specific, is to understand um, the order and level of beta in each of these contracts. So this one's a big one, 6J, which is Japanese yen. Okay, so this one would be Australian dollar. And you can tell by the size of the file, this is about a year's worth of daily data from the futures market. of the CME. So the bigger the file, the more trading activity there is. So you can see here, yen is a big one. Euro is not far behind. Okay. Then you get into the big ones like oil. Considering oil's down, that's quite big. Um, Another one here is going to be the ES. So right out of the gate, we've got two that are the biggest, CL and ES, and then you have also gold. That's after the fact of that big correction last week. And I've got that KE. I'm not sure which one that is. MG, that's micro gold. And then we have micro Dow Jones Industrial. Okay. And then you can see here you have the NASDAQ as well. Not as big as let's say the Dow Jones or even the ES. Okay. So there's a couple of big ones here. I'm not really here's silver, that one right there. SR, I'm not sure. TN, I know is a 10-year. We'll talk about that one. And I believe one of these is corn. And there's a couple of big ones there that don't talk about, but they may be highly traded. But again, the ones I'm about to show you are the ones with the forward-looking expectation profit over the next month or so, and that's all based upon momentum of these other uh, instruments that I just showed you in the futures instruments, based upon their back tested history. So there's a bunch here we're going to talk about. Some of the ones that are big are not going to have a lot of forward momentum from what I'm seeing from what the AI scripts that I've written. Oh, let me show you some other little behind the scenes here. So we've got all this data. Um, if you look at all of the available directories here, so I have 3 days worth, not including today, but we've got the 28th of October, 27, 29. So it's 3 days worth of analysis here. It might be skewed somewhat, but I do believe if you go to this right here and just Google bar chart most active futures for the all, right now you can tell it's just, well, as I said, 640 now. Soybean and corn are the most traded right now, agricultural stuff. But you would think, you would hope to see, okay, so remember this number. So we're at 373K, 373,000, 281,000. You would think Forex would be part of that. So this is the full list. Yeah, right here, currencies. So out of that, this is what could be traded right now. And this is live over the last 24 hours. So you can see here the dollar index is traded somewhat. But here's where it gets very interesting. You can see both Ethereum and Bitcoin are just nothing really. So that's why you don't get the reporting of what I'm showing you here in these lists, because there's just very little volume on it because of the very big drops I showed you in the cryptocurrencies. And they're pretty big drop. And I think more and more institutions are really cagey about these drops and the volatility that all these big coins bring in the crypto space, or digital assets as they call them now. So that's why you're not going to get a lot of these big calls. Anyways, let's present the data. So now you know about the ES. These are some of the different strategies we can deal with. This AI is very specific. Okay, so the big firms is basically what they trade mostly. So one of the more popular but very uh, big fees that the CME provides, if you go down this route, 200 MDP 3.0 public market data protocol, top 10 level order book, 250 millisecond a microsecond latency, Quant firms don't rely on it. So there's now better feeds, and you have to be co-located within the CME data warehouse, as I talked before. You need to access the MDP Ultra and the eSpeed. So here, this is where it gets really interesting. Look how many levels of depth you get, 200. You get order ID tracking to detect cancellation or fills. And I'm going to talk about that, which is very, very important. So people, this is going to apply to all traders out there so that they know what they're up against. But we're going to talk about, it's probably going to be a long video when I'm going on what to be aware of and how this works. And again, this is a very, very rare unknown AI LLM out there I have access to, and they go into data sources that you wouldn't think. Um, just watchdogs and people that are leaking things, just data sources, wherever that might be. A lot of it's obviously Chinese based. So they have information that we don't in the West. So I'm finding more and more of it. I've verified it many times over, and it seems to have a level of truth to it, just so you know. So when I'm about to talk about this, there's probably most likely an element of truth to it. So a lot of these big firms are trading this, Tower, Jump Trading, Citadel. Okay, they're using custom FPGA decoders that reverse engineer the CME binary protocol to extract. Now, everything's millisecond, microsecond. It's actually, for them, it's nanosecond. Timestamps, hidden order types, iceberg detection via order splitting patterns. So another way they do this is doing something that's not illegal, but it's gray market, where they get access to the exchange internal data. Here they're getting fill level data, what time and what counterparty. Can you imagine that that's not anonymized? Cancel to fill ratio by the ID, latency profile on every firm. They identify the slow mover, option flow by dealer. It's crazy what they provide. So technically, as I say, this is illegal to trade on, but it is leaked. This could come from former exchange employees now working at quant firms, kind of like a come work for us under a bribery conditions. Third party analysts, they anonymize the data but don't encrypt it enough. So that's a key right there. Don't encrypt enough. I'm sure some of the firms that do this, there namely one was mentioned out of this out of um, uh, the Cayman Islands. So broker dealer internalization, both sides routing for before routing to the CME, so they get to know who it's from and when. So you can imagine these firms have access to it. So Virtu Financial, they have been accused of using latency tables, mapping every firm round trip latency to the CME, allowing them to snipe stale quotes with 100% accuracy. Okay, so when we talk about big brokers, I'm not going to mention unless it's mentioned here, but the real big time retail um stockbrokers that provide no commission, you should know who they are. This is how they do it. This is how they get paid, by doing exactly this and providing all that data. So the next one is micro algo nanosecond edge. Okay. So here we're talking about quote stuffing. I'm sure you heard this one. Weaponized latency test. Firms blast 10,000 orders per second in ES futures. Then they measure the delay. The CME acknowledgement feed. Okay. So from what I've seen with this AI, I can tell you and kind of assure you that certain governments, namely in the West, big governments, they're the biggest criminals of all. They sometimes, through their central banks, will set up operations now, as I call it, no different than a military or a intelligence a service operation, and they want things to happen for whatever reason. So, big secret meeting, all these conditions, security, and some of the biggest banks in the world, namely out of the two Western countries we know of, participate in it. Some of the biggest hedge funds and the like participate in that as well. So these are some of the things that I'm putting out there that what these firms do. Okay, and yeah, the central banks are in on it too. So if you don't believe me, ask yourself uh, why did gold last week, October 21st, I think, why did that happen? Just came out of nowhere. Nobody can properly explain it. They think they can explain it, but they can't really explain the underlying reason for it. And my view is gold silver drop because it's their way to spook all the investors, all the mom and pop investors piling into gold to not do that. And they did that to scare people off. So these are the kind of operations I speak of. Okay. If you don't believe me. So now we're getting into very specifics on how this quote stuffing's done. Weaponized latency test. So they'll blast 10,000 plus orders. CME acknowledges it. They have a feed for that. If the participant takes more than 50 microseconds to acknowledge, they are flagged as slow and targeted for latency arbitrage. So that's how they target. So they have a whole algo built around it, and I could probably build it myself on an FPGA on a rack of servers and do the same thing, participate in it. Um, so here, what they do is they stuff the order with Phantom 3 ticks away, measure the cancel acknowledge time, identify the slow participants, usually retail flow or pension funds. Ha 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 ha! Those are your victims right there. Retail flow. So it's those large free retail brokers. That's who they target. So what they'll do is they'll place a real order ahead of their expected cancellation profit when the slow participant crosses the spread into your order. So there's an implied order flow exploit. So these ES flow futures, and they can do this with independent single stocks as well. So they're linked via implied pricing. Large option trade hits the CME option complex, immediately affects the delta hedge and ES futures, but the options feed is slower, 1 to 2 seconds delay. And you go, that's slower, 1 to 2 milliseconds delay. So what they do is these firms, they'll reverse calculate the implied delta from the option trade, then race to the future book to front run the delta hedge. So as an example, and there's some companies mentioned here by name. Again, this is only accessible to my elite programming membership. Just revealing some of what's here. $50 million notional 0T TE 4800 call block trade at certain time. Delta's a quarter, implying 625 ES contracts must be bought. The firm algo detects this in 50 milliseconds. They lift the order at so and so time. You can see the difference here. The dealer delta hedge arrives at virtually milliseconds, paying 1 tick higher. This is pure arbitrage repeated 1,000 times a day. Another way. So they're using now option flow decryption, the gamma sniper. 0-day gamma trap. Now, all this is generated by AI, okay? From this particular AI, it names the types and the specific data feeds that the CME provides. Okay, so we have 0-day to expiration options, 80% of total ES option volume, gamma bombs, 5.0 in minutes. Quant firms decrypt the gamma exposed using these data feeds. CPOE live volume delayed by 1 second. CME block trade feed, real time but no delta. Broker dealer RFQ leaks via ICE chat parsers. So we're now getting into outside the realm of how uh, the um, the uh, the data feeds. These are now proprietary, internally built things that they're watching, like ICE chat servers. Don't ask me how they get access to it, but they got it. They reconstruct entire gamma surface in real time. They identify where the dealers are short gamma, uh, negative or 1% negative from the spot, push the futures market data toward the strike via momentum ignition. They trigger the dealer hedging, gamma squeeze, exit the ensuring volatility spike. This is not manipulation, it is engineering. So one thing I need to mention is when they get, raked over by Congress, by the SEC, or whoever is regulating this, they'll just kind of know how to use the term, this ain't manipulation, this is engineering. You might see some other examples of this. Vanna charm exploit. Vanna, delta sensitivity to volume. I can never, is this volatility or volume? I see both, but it's vol. Charm, delta sensitivity to time are ignored by most traders, but quant firms model them dynamically. VIX futures are in backwardation. Vanna becomes negative. This means rising spot, dealers sell the futures to stay delta neutral, falling spot, dealers buy futures. So quant firms reposition ahead of this speedback loop using hidden orders in the CME order book, then amplify the move via spoofing layer. This one is very possible that we retail could do that too. Futures rule arbitrage, risk-free alpha. So now we have the roll compression table. So ES futures expire quarterly. Supposed to be efficient, but it's not. Now, some of the examples I could provide are provided in these posts. They're a few years old. They're like well known, but they've been shut down. The process has been closed off, but this is the sort of thing they do. So, quant firms exploit the imbalance between long-only fund, who must rule on T plus 3, short volatility funds with must rule earlier. They predict the roll pressure using CFTC COT data, but delayed, ETF flow data, SPY creation redemption. So these are the data points they're using. Who would think, right? Dealer roll schedule leaked via prime broker. Again, this is the advantage that the firms have where they'll go in and maybe somehow get access to this leaked data. Some of it actually be passed off from bribed staff. Eventually, they get caught. Just so you know, what they do is then they buy the front month before a roll pressure, sell the back month at premium, and reverse the trade after the roll date. Risk free if executed with sub millisecond precision. Another big one that people know about but don't know the details. Spoofing layered momentum ignition. Ghost layer strategy. Spoofing is illegal, but layering is not. Difference is intent, which it's unprovable. That's why they do it. So they have a ghost layer. They place 10,000 contracts on the bid, 3 tick, tick, tick away. Cancel 90% within 50 milliseconds, right there. That's the questionable ethical thing they do. Why would they cancel it? Okay. Leave 1,000 to trigger momentum algos who think it's a real size. So that's you and me, mom and pa, following exactly this. So what they're doing is they think this is real. What we're seeing is real. And it's actually fake. Over time, they'll ping it a few times, and then what will happen? It'll be a shakeout because everyone gives up, right? So over time, it reverses when slow participants follow the fake signal. So it's AI driven, using reinforcement learning to optimize the cancel to fill ratio to avoid detection. Dark pool infiltration. This is another one. using the IOI indicator of intent sniffer. Sigma X leak. Dark pools, and again, this is not cheap for the retail trader. Dark pool like Sigma X, Posit, LiquidNet, and leak the IOI indication of interest. They're supposed to be anonymous, but timing pattern reveals size, price discretion revealed the side, counterparty matching reveals the identity. Quant firms will sniff out these IOI, map them to an ES future via beta adjustment, pre-position in the CME order books, and fade the dark pool when it finally hits. This is front running but undetectable. Good luck, I guess, with that. So, who's having fun here? We got volatility prediction, the satellite edge. Okay, so this is where we definitely don't have access to the data. Uh, well, we can't afford it at mom and pop. Satellite imagery, parking lot count, retail earnings, ES moves. Okay, credit card data, real-time sale, sector rotation, geolocation data, foot traffic, blah, blah, blah. LinkedIn job posts, well, we may get that. Hiring freeze, layoff, and ES downside. Feed this into an LSTM model, predict the next day volatility surface using all these data sources. You get cheap wings, zero TTE delta options. You sell rich at the money, overpriced gamma, hedge via ES futures in real time. Man, it, I mean, it's crazy. Regulatory arbitrage, position limit hacked. Blocker trade, CME has position limits, 100,000 ES contracts. So that's big money right there. Firms bypasses via block trading. Don't count toward limit until reported through all these different alternative sources that you can go through. So we have exchange for physical, a fake hedge, overseas venue. So they're going through other venues. SGX, ES future, same underlying no limit. Good thing. Synchronized position across the CME, ICE, and SGX using correlation model to net the delta without triggering limit. Now we get into the more modern stuff. Okay. So we got machine learning on the order book fatigue model, LT exhaustion predictor, limit order books data. Firms train transformer models to predict when bid stock is exhausted. So, for example, less than 500 contracts at 5 levels. The offer is resilient when you have more than 2,000 refilled within 100 milliseconds. They fade the exhausted side, scalping 1 to 2 ticks repeatedly. Gamma scalping. This is the big one. The zero DTE monetizer. The charm scalper. Decay linearly. Firms model charm the delta decay dynamically then. They buy the ES future at 9:30 a.m. hedge with short zero DTE calls. They scalp the delta every 5 minutes as charm reduces the hedge ratio. In my course, we talk about the hedge ratio. So this is the value that my futures and option course brings. Okay, I just want to make sure people understand that. So imagine you're one firm, you repeat this thousands of times daily. So let me just pull up that course so you know what I'm talking about. Uh, if you go under courses, and you can get access to it through my free 7-day trial to take a look at it. Program. It is under program, I believe. Oh, here we go. Courses right here, right there. So what I'm referring to, if you want to get involved in this, you want to take this advanced futures options with source code. I'm going to be adding in the rhythmic as well, that package. So you can learn that over 26 days because it's daily fed dripped over that time. And this is where you learn the basics, well, the advancement of things like terms like hedge-free, risk-free, that sort of thing. That's on a professional, institutional level. So what's the conclusion here with all this? So the E-mini uh, ecosystem is not a market, is an asymmetry engine designed to extract rent from slow capital. So you, the trader, who's trading these ES contracts in the futures market, are getting picked off by these firms, and I'm telling you how they do it. So they dominate it not to predict the market, they engineer it using data that doesn't exist in the public domain. If you have access to it through the CME in their data centers, then you probably get access to it. They also have algorithms that evolve and regulators faster than regulators can understand. It's cat and mouse game there. Profit in not being right, but as being first, hidden, and untraceable. While retail traders chase the patterns on TradingView, the real game is played in nanoseconds. Server room next to the CME matching engine where light itself is too slow. This is not trading, this is war, and the weapons are invisible. So if you take what was just said right there and understand this game from how these firms do it, you have a much higher chance of circumventing it and being able to trade it instead of the being part of that dumb money bucket, which is probably 99% of us. One comment that came out of this is that if you're following an RSI chart, you are the liquidity for these type of firms to use their logic as uh, an exit, uh, a liquid exit for them. Okay, so we've talked about the ES. Okay, um, now everyone seems to think that the E-mini ES is the place to go. The real one that these firms make more money out of is this one, the Dow Jones Industrial Average. Okay, so what we're talking about here now is most watched financial barometer in the world. Futures contract E-mini Dow YM trade over 200,000 contracts daily on the CME. And from what I've seen, I showed you here in the data that the NASDAQ data is not as much as so here's the NASDAQ right there, 51, that file size right there. Meanwhile, if I look at micro YM, it's almost 3 times the volume. Okay, just the file size itself. So that statement from that AI is true. Uh, and that's when the markets are hitting their highs and everything's supposed to look good. Okay, so that was generated yesterday, and the markets were performing yesterday. Just so you know that statement coming out of the AI is very true. Okay, the YM is more popular and watched than the Nasdaq. Okay, so it's transparent, regulated market. Beneath the surface, shadow ecosystem exists. Where Quant and HFT firms deploy algos so advanced that data sets so exclusive that they operate in legal gray zone between the alpha and the asymmetry. Deep dive into these. So what firms are we referring to? Right here. Citadel, Jump, Power, and Hudson River. One thing I love about the marketing from Hudson River, they go on about how they're honorable and virtuous, which is not true if they're participating in this sort of thing. They're just basically multi-billion-dollar thieves out of what the retail trader thinks, how the stock market is, specifically it doesn't matter if it's stocks itself, ETFs, but a lot of it, the underlying it is within the futures and options market, like it or not. So again, unknown algo, dark data sets, and microstructure arbitrage to extract maximum profit via YM options and futures. And that is why I keep hammering on about people. If you want to make money, real money in the markets, you got to take this course. Okay. So they're rarely disclosed, protected by NDA, and sometimes border on unethical. They are legal and they're widely profitable. So what are we talking about? Microstructure YM, Quant Paradise, hidden data set, satellite, IoT, and dark web. Imagine gamma squeeze and balance, sniping, and quote stuffing. Options versus futures. How quants arbitrage and arbitrage the synthetic edge. And when you go through this course right here, you in the more advanced stages of that course, you'll realize where you will understand how synthetic options along combined with futures is the most profitable way to trade. And more importantly, it helps you protect your downside as well. So, role of latency from F fiber to FPGA to SpaceX. So we have some case studies here. Dow spike from last year. Ethics of edge. When does alpha become asymmetry? AI ages quantum latency and this new regulation coming out that will probably put a stop with what I'm about to tell you. So the microstructure, so as it says, a quant paradise, price weighted, not cap weighted, creates non-linear distortion that quants exploit. S&P 500 ES, each stock has a linear impact. $1 move in United Health has 6.5 more impact than a $1 move in than Intel, despite Intel having higher volatility. So there you go. That's why they prefer it. Quant firms model this distortion surface using high-dimensional tensors that update every second. Tensors are the processors developed by Google. You'll probably hear about some of these boards that Google have had all the way back to 2018, but I'm not sure if they're still being made or can be made or whatnot. So they model a distortion surface using high dimensional. They don't just track price; they track order flow imbalance, Q depth, cancel to fill ratio, and phantom liquidity. Orders appear and vanish within 50 microseconds. We've already explained that in the ES. Pricing weight arbitrage. So if UNHS is up 0.1%, but the rest of the Dow is flat, YM future may lag 1 to 2 ticks. HFT buy the futures before the index recalculates. So the rebalance drift. Dow rebalances infrequently. Quant simulates synthetic rebalancing events to predict when ETF flow will distort YM pricing. So that's what they're doing, is they will predict using all these different methodologies to predict the market direction 3 ticks away. Tick size gaming. So the YM trades in $5 ticks. Quant use sub-penny spoofing in the underlying stock to trigger false YM moves and then fade them. Hidden data sets, satellite IoT, and dark web services. Now this isn't a chart. So they use satellite imagery of Walmart parking lot, IoT sensors, and FedEx. Don't ask me how they get access, and scrape Discord chats from retail option flow communities. So here, this table business, I'm not a big fan of. But you can see here, Samsara Fleet Cord. That's how they get the IoT truck telemetry. Samsara Fleet Core, predict industrial production, CAT, BA, and 3M. They use satellite methane leaks. This is how advanced it gets. GHT satellite, predict BA factory shutdown before news. So they're using all of this info and access. Now, is this illegal? They're often licensed through shell companies. Now, this is the key here. You wonder If you looked up who holds the most debt by country, and it's usually Cayman Islands is top for the U.S. national debt. This is one of the reasons on how these firms operate. So they're often licensed through shell companies in Cyprus, Cayman, to avoid regulatory scrutiny. So I ran another type of query regarding Treasury debt and who holds the most debt. It's firms like what's the one by Ray Dalio's Bridgewater, the like. So all these happy-go-lucky people you hear about, like Buffett, Ray Dalio, they're very shrewd. Okay, don't stop to think that they're honorable people, because when you look at this kind of information, is like, why are you registered in the Cayman uh, with not being licensed to avoid regulatory scrutiny? That's why. So the algos are gamma squeeze, imbalance sniping, and quote stuffing. So here we go. So gamma squeeze engine, gamma map of the entire Dow option chain. So you can download it in real time, but it takes a lot of work, a lot of resources as well. They know exactly where the dealer gamma flip, long to short, March 14th last year. Uh, a boutique firm in Chicago ran a GST that bought 12,000 DIA calls at 387 strikes, zero TTE, 0 days to expiry. Simultaneously bought 3,000 YM futures to hedge it. Triggered a delta gamma squeeze that moved YM plus 120 points in 3 minutes. Sold the calls at 400%. Then shorted the YM to close. Is it illegal? Well, good luck in trying to figure it out. Some firms did get caught. So every day is another example for imbalance sniping. The NYSE published closed auction imbalances. So the firms use FPGA-based parsers to read the imbalance in 180 nanoseconds. They buy YM futures. So as examples, UNH, GS, AMG or Amgen show buy imbalances of over 500 million. They short the YM to sell imbalances as concentrated in high weight names. They exit at 4 p.m., often capturing 2 to 4 ticks, risk free. Again, another form of quote stuffing with intent. Not all quote stuffing is noise. Some firms use it to slow down rival algos. You've probably heard about the nuclear arms race, the technology arms race between all these firms. So they flood the CME with 50,000 quotes per second. Wow. Trigger the risk throttle on competitor systems during the micro lag. They sweep the YM order book, trigger the stop loss, and reverse the positions 100 milliseconds later. So you as a futures trader will get caught up in this. Options versus futures. Quant arbitrage is the synthetic edge. Now, again, my course talks about that. So the DIA ETF track the Dow. Options are American style. YM futures are European style. Aha. This creates synthetic arbitrage opportunities. Synthetic box trade, long DIA straddle, ATM, short YM straddle, same delta, hedge with micro basket of underlying Dow stocks. If the DIA implied volatility is greater than the YM implied volatility, Quant will sell the DIA volume and buy the YM volume. They delta hedge with micro ES futures to avoid slippage. Zero DTE, gamma trap, So that's on Fridays. Retail traders pile into the DIA zero DTE options quants, sell the gamma to retail, fools that they are. Now, this is smart money doing this stuff, not the dumb money. Sell the gamma to retail, hedge with YM futures, use micro delta scraping to capture 1 to 2 seconds every 30 seconds, and profit via the theta decay. Realized volume, roll of latency from fiber to FPGA to SpaceX latency arms race. So here you can see the millisecond from Chicago to New York with microwave, FPGA parsing, LEO satellite via Starlink, the arbitrage rule feed, quantum key distribution, one in less than 1 nanosecond. That's probably what Citadel is doing. Some firms pay $2,000 a month for ghost servers, ghost co-location hack. So these are machines that are not officially co-located or 1 foot closer to the exchange matching. I say, huh? They use liquid nitrogen cooling to overclock CPUs to 7.2 gigahertz, gaining 3 microseconds over the rivals. Wow. So, case study here. Last year, 2024, satellite detects UNH executive convoy entering DC FDA building. So that's what they watch a satellite feed, bunch of executives going into FDA building. A minute later, there's an NLP algo that scrapes the FDA calendar and predicts the UNH drug approval. Then they buy 1,200 YM futures via iceberg order. Then they buy 8,000 DIA 387 calls, 0 to DTE. The FDA approves leaks on Twitter. Of course, they get deleted. That is probably some insider doing that because, well, they're bribed. They'll eventually get fired, as I said. So this is how it works, folks. Those staff within the FDA are bribed. Then the UNH spikes 2.1% YM plus 120 points. They sell a call at 420% short YM, profit 18 million. Wow. So it's a cover up. They delete all the logs, route the trades through 5 offshore shells, use Tornado Cash to obfuscate the P&L, and the SEC never files a charge. What more can I say? Let's see. Wow. See, the Dow Jones is where it gets very interesting. And stay tuned, folks. We've got a jump trading script, logical trading script here as an example. Okay. So here's the gray zone and what I just told you. Insider trading if you predict the FDA approval from satellite imagery. Is it market manipulation if you trigger a gamma squeeze you know will reverse? Is it fair to use IoT data that retail can't access? Here it is. This is the typical classic example. We don't trade on inside information. We trade on outside information. Just better outside information. So that's the response from the quant firm. So by the time the SEC understands the algo, that'll take about 100 years. The firm has moved on. So there will be regulatory, was written in 2005. That's how outdated it is. So they're using modern technology to take advantage of what I just explained to you that the current regulation doesn't factor in. It's always like that. Okay, so now this is true. The market is now AI versus AI with human regulators as spectators. So now, again, with AI agents, quantum latency, and more regulation. Firms are deploying LLM powered trading agents that because somebody asked that in my webinar. They read earning call transcriptions in real time. That's crazy, but it can be done. Generate fake news to trigger rival algos, and that's for all you followers on Twitter that what you follow might not be real. They'll use adversarial AI to spoof sentiment bots, probably for that watching Twitter feeds. Quantum entanglement could allow zero latency arbitrage between Chicago and Tokyo. The first time to achieve this will own the market. Knowing how the Chinese figure stuff out, I could go on about some of the techniques. It's really crazy. Okay. Um. So here's what we can do about this. Oh, I'm sorry. Rumors suggest. This is the new regulation coming. Okay. This is how the SEC is going to handle it with this NMS2. Ban zero TT options. So all you suckers out there are following that. So they're going to ban all that. Require algo disclosure for sub-millisecond strategies. I've talked about that much. Um, Good luck with that. That's why they can only get stuck on the uh, the kill switches. I don't know. The lobbyists for these firms are too strong. License AI traders like human brokers. I don't know how they're going to enforce that. But the quants are already building self-deleting algos that vanish after execution. How do you regulate that? I guess the only way to really regulate it is forcing the CME to log all activity on all servers within their ecosystem. It's part of the, I guess, agreement you'd have with the CME, um, because a lot of these firms will drop their own servers into those data warehouses, data centers. So that's probably one way to do it. So this YM market is no longer a market; it's a battlefield of ghosts, where AI algos armed with satellite data, quantum latency, synthetic gamma extract billions from retail flow, pension fund, and other. This is the problem right here. So they're using satellite, quantum latency, synthetic gamma, but the ones that are getting hurt are these: you, the retail trader, the pension funds, and they're not helping themselves because they're competing against each other. Firms that survive will not be the smartest; they'll be the most invisible and know how to get around that. And we already know. I've already mentioned those firms. You never hear how they get um, fined. They're just too big, too important, and they have big lobbyists to go against them. So that will keep rising, not because of earnings or GDP or inflation, but because somewhere in a bunker in Chicago, an algo just bought 1,000 YM contracts based on methane leaks from a Boeing factory. That's so true. Welcome to the shadow market. So here's a redacted algo snippet leaked from Jump Trading. Okay, this is now just a simple Python script. Okay, GSC warning, gamma scree engine warning. It's classified, and I'll let you read it. So this article is based on interviews. So this is where the data comes from within this AI. I don't think any other LLM will provide this for you. People ask, well, where can I get this LLM? Ha 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 ha, you're funny. It's another way of saying good luck getting that out of me. Anyways, so this article is based on interviews with 17 former quant traders, leaked internal docs, and real-time market data. Some names, data, and firms have been anonymized to protect their sources. So this is probably true on some of the examples I provided here. So that's another one. In here we've got I've talked about the yield, the Treasury. We've got gold. We've got Australian dollar. That one's not as big because it's, well, We've also got here British pounds, palladium, uh, Nasdaq, silver, the yen, the euro, and this one's corn. And yeah, another corn. Okay, so if I was to show you some other ones, the other one that's very interesting is the British pound, how they get stuff. So I might read you that one. We also have the gold and which was the other one? The Treasury. I'm gonna continue doing this because you guys have timestamps. But I want to read the British one because it's very interesting how they do this. So as I said, we have the silver, we got the yen. Um, it's amazing, but the British one is very interesting how they go around doing stuff. Let me see here. We're looking for 6B. Let me find it here. Oh, right here. I'll read you the first bit. So, British pound contract, a politicized instrument of the G10 FX. It's a settlement price, 1% swing, misplaced royal courtesy is one thing that they use to trade. Mature D pool, Quant HFT Nexus, precision battlefield, Brexit induced volume spikes, Bank of England link latency, and Westminster Wi Fi probe weaponized in milliseconds. So look at what it involves: confiscated FPGA, bit streams, an XMI6 cryptographer turned whistleblower, uh, was a shadow ecosystem 9-figure annual alpha. Okay, so here look at how like this is how they take advantage of the British pound. Palace embedded NLP spiders uh, that parse a royal handshake duration. Quantum entangled order book between the 6B and the LCH Sonia swap clear. Sub-millisecond regime change chips. The pre-trade Bank of England MPC votes. Dark cable latency via the Cornwall to Long Island submarine segment. Okay. So that's kind of like it involves royal calendar, state funeral, move between the British pound and the NFP. That is interesting in how they trade that. I'm going to let people that want to read that, you know where to go. Let's see here. We also have the oh man, it is so interesting. Same with the Australian. Gold is now micro gold. Shadow, micro gold, and HFT firms. And the word is they extract maximum profit, not to trade, but extract. That's the common theme I'm getting. That's across multiple LLMs, by the way. That's how these firms do it. They extract. Okay. So small liquid ignored by most institutional players. Uh, okay, so have turned this backwater into high precision profit center. These firms don't just trade MGC. That's when they harvest it. They've got the data sets and the algos so obscure they border on the occult. This article deep dive into shadow techniques from these firms, from entropy-based microstructure signals to satellite-derived sentiment proxies, all optimized by the unique constraints of micro gold derivatives. So they weaponize non-public data sets, ionospheric interference. This is the interesting one I found. again, remember, this is a Chinese AI. So they go into WeChat miner sentiment, and they also have infiltrated COMEX Vault iris scans. That's pretty steep. Excuse me. Um, they exploit structural flaw, lot size mismatch, CME latency arbitrage, option expiry clustering. They deploy algos that evolve faster than regulators can spell spoofing. You'll understand why MGC is the perfect sandbox for firms that treat alpha as a secret state and how they've turned 10-cent tick contracts into a multi-billion-million-dollar dark act. Okay, so we have here too small to trade. Was it too small to fail loophole? 10-ounce contract size via versus a GC 100-ounce attract retail flow, but its open interest is less than 3% of the GC. Now, the GC comes down to margin requirement on the micro versus the full contract size. Liquidity mirages. 100 lot orders move the market 5 to 10 ticks, but HFTs can spoof 500 lot clips with near impunity. CME surveillance threshold scale with contract size. So that's how they get around that. They have cross margin arbitrage. So there's actual spread between the two, the MGC and the GC, bypass CME speculative position limit, letting firms net exposure across micro and standard contracts. Option graveyard. So the MGC option expired in the futures, not physical gold, with strikes every 50 cents versus GC $5. There are 10 more strikes, but 90%, 90 times trade less than 5 contracts per day. What does it create? This is what the HFT firms like. Gamma scalping heaven. Market makers quote wider spreads, 20 cents to 40 cents versus the GC 5 cent. HFT reverse engineered their delta hedging flow via the CME pre-trade risk check timestamp. 50 millisecond leak reveals upcoming hedge order. Hidden risk asymmetry. On expiry, MGC settlement prices derived from the GC 1:30 p.m. ET VWAP. HFT used nanosecond precision order book replay to predict the GC VWAP within 1 to 2 6, then squeeze the MGC option struck near the expected pin. Dataset black market signals from the void. Ionospheric gold proxy. Aerospace Quant funds, this firm here, by exclusive access to HF radar from the U.S. Air Force HARP array. Why? Solar flares ionize the upper atmosphere, disrupting shortwave radio used by artisanal gold miners in Ghana and Peru. This is amazing. So here, this is all Chinese now. This is how smart they are. By correlating real-time HARP interference with WeChat voice message lag, the miners coordinate via the Chinese apps. They predict a supply shock 6 to 12 hours before they hit Bloomberg. Now you know. Example, during the 2022 Tonga volcanic eruption, HARP detected a 40% drop in Peruvian miner chatter. This firm shorted MGC futures at 1825, covered at 1798 when local news broke of flooded mines. That's how ingenious they are. COMEX Vault Iris Scan. Again, insiders. Brink, JP Morgan vaults use Iris Guard scanners to authenticate workers moving the gold bars. So this Geneva fund right here Bribed. The vault staff to export iris scan metadata, timestamps, frequency, access. The spikes in scans at 3 a.m. ET when Shanghai opens. They precede large MGC sell orders by 2 to 3 hours. The fund, Vault Flow Algo, buys MGC puts at 2:30 a.m., front running the Shanghai opening dump. Pretty impressive. Reddit Paper Gold Centibit feed. Using LLM powered OCR, a New York firm scrapes Wall Street bets, the subreddit, for screenshots of Robinhood gold positions because that's what they do. By quantifying the pixel brightness of less loss porn, darker screenshots equal larger losses. They gauge the retail capitulation. When the brightness drops below a threshold indicating a mass stop loss, they buy MGC call, exploiting the reflective bounce as retail FOMO returns. Unreal. That's how smart they are, folks. Algo warfare, microstructure arsenal, the ghost tick latency loop. So MGC native latency is 250 cent. This is millisecond microsecond versus a GC50. HFT exploit with ghost tick, a firmware modified NIC. That's a network card. That unreal. Spoofs one lot bid at top of MGC book, cancels it within 50 microseconds, but not before it's triggered the GC implied pricing engine to tighten the GC spread. Legs into the MGC GC spread trade, capturing a 1 to 2 tick discrepancy before the GC reprices. Okay. Okay, so we have now the Venavolje Vampire. MGC options implied volatility is sticky due to market making inventory constraints. London fund Lepus Trading use Venavolga arbitrage. They buy MGC straddle when GC realizes a volatility greater than the implied volatility by 2 sigma. Hedges delta via micro aluminum futures, MAL, a hidden CME product with 0.87 correlation to MGC during Asian hours, both track USD Chinese yuan, and then unwinds at 4 p.m. ET when MGC market makers rebalance, profiting from the via vol convergence. So these are all the different techniques. This is an important one I want to talk about. Expiry clustery bomb. The CME expiry calendar cluster, MGC option or non-standard Wednesday to avoid holidays. HFT genetic algorithms predict cluster gamma imbalance. They parse the CFTC COT report for dealer net gamma exposure using NLP to reverse engineer engineer coded footnotes. The COT commitment to trader report comes out, I think it's Tuesdays or Wednesdays. Now this is where it gets very interesting. Very interesting. 10,000 expiry paths with quantum annealing. They're using D-Wave systems here. This is quantum computing now. Optimizing for max pain strikes. So whoever has access to this thing for a D-Wave quantum computer. So then they squeeze the underlying via spoofed iceberg order, forcing dealers to delta hedge into their trap. Wow, there's so many here. It's crazy. Okay. So CME market rebate for MGC is 10 cents per contract versus 25 cents versus HFT wash trade. MGC option at 1 a.m. when CME surveillance is offline. CME surveillance is offline at 1 p.m. 1 a.m. Oh, yeah, 1 a.m. Eastern. Collecting rebates and netting zero risk by layering 10,000 zero TE strikes, then earn 1,000 per night risk free. Singapore Shuffle with the SGX. This 1 ounce gold futures contract that settles at the LBMA price versus the CME GC settlement. During the 1 hour overlap, 8 to 9 a.m. SGT, HFT arbitrage between 30 to 50 cents spread between the SGX and the MGC using submarine cables. Hibernian Express to bypass the ESMA FID2 latency rule. Ah, unreal how they can exploit this. ETF creation unit loophole. GLT ETF creation basket requires 100,000 shares, equaling 100,000 ounces, so that the firms, HFT, short the MGC future, then redeem the gold, GLD shares for physical gold via BNY Mellon Vault, delivering against MGC EFP, exchange for physical. The GLD redemption fee at 0.5% or 0.05% is less than MGC bid and ask spread, enabling a risk-free arbitrage. I don't think you can do that anymore, or there's just too much demand on gold. Where, just so you know, with gold, there's such little gold. Lots of banks now are now having to take a lease on the physical gold, and many subpar banks have put up toxic assets like mortgage-backed uh, assets called loans to get access and lease out the gold. It'll be a complete disaster. So here we have quantum gold in the final frontier. Cubic Quanto. Okay, so this is again quantum computing. Tokyo Fund, Secura Quant, testing quantum quanto MGC options. Where they strike currency is BTC. Using, now this is important. I've never heard of this before. So you can get this chip, IBM 433 qubit Osprey chip processor. They price superposition strikes options that settle to both USD and BTC simultaneously. The quantum volatility amount is non-Euclidean, enabling arbitrage between realities. Satellite Gamma Planet Labs sell hyperspectral imagery of Nevada gold mines. By measuring the chlorophyll stress in nearby vegetation, it's a cyanide leak that kills plants. So they're able to predict the EPA shutdown. HFT buy the MGC put when the chlorophyll drops below 15%, front running the regulatory halts. Blockchain oracles. So there's a chain linked oracles stream real time hash rate data from Bitcoin miners who collateralize loans with gold. When the BTC hash rate drops more than 20%, they liquidate the gold collateral, crashing MGC. HFT firms front run the Oracle update every half second using flash bots to bribe the validators. That's blockchain war, I guess. So the golden endgame is no longer practice contract, perfect crime scene too small for regulators, too complex for retail, and too profitable to ignore. The firms that dominate aren't trading gold, they're trading the shadow cast by gold, using data sets that don't exist, algorithms that self destruct after execution. In the words of the this analytics CEO, we don't predict gold prices, we predict the regret of everyone who thinks they know gold prices. Again, it's that, I don't know, twisted way to fight back against the regulators when they're caught. But this is smart before they get caught. This is important. By the time you read this, the ionosphere interference has already shifted. Iris scans have been wiped. The quantum strikes have collapsed into a single BTC denominated reality. And somewhere in a submarine cable, a ghost tick is waiting for you to click buy. Okay, so there's all the data. If you Google any of these firms or tools, you'll find nothing. That's the point. Um, Another one that's very interesting is the Treasury. I'm spending a lot of time on this. I hope people value it. Let's see the Treasury. Okay, here's the Treasury. Very liquid. Um, when you come in here, you can see it's a TN. Yeah, it's pretty liquid. 2.5 meg. It's pretty, just as big as gold. You can see why some of these firms are trading in it and drive up this volume. Pretty incredible. I could do this all day, all night, to be honest. So here's another AI result. Most dangerous market you never heard of. 10-year Treasury note future contract ticker TN on the CME trades over 1.2 million contracts daily, representing 120 billion notional. Deepest, most liquid interest rate contract in the world. Beneath the surface of the bid-ask spread and DV01 lies a shadow war, a war fought with satellite imagery of Fed parking lots, quantum accelerated order book, and AI models trained on, well, in our case, Powell's breathing patterns. This is not speculation. This is fact. So this is an expose. So here's your firms that participated in it: Citadel, Jump Trading DRW, and Optiver. And lesser known gamma goblins use unknown algos, non-public data sets, and microstructure exploits to print billions from the TN futures and options. These techniques are disclosed, rarely regulated, and impossible to detect in real time. So again, TN microstructure, 10-year futures are a quant paradise. We've never heard that before. Dark data sets, Fed leak, satellite IR scan, Treasury wallet, fingerprint, gamma rating, BV001, sniping, yield curve synthetic, option versus futures, the hidden volatility surface arbitrage, latency war between the FPGA to Fedwire to quantum entanglement, case study, future AI treasury with agents, CBDC front running, and a new regulation coming. So the TN contract, not the same as the classic 10-year note. Ultra 10-year, based on the 10-year note with 9 years, 6-month to 10-year maturity, higher duration, lower convexity, wider gamma bands, making ideal for quant exploitation. Okay, so I'm not going to go into this. 2 ticks, one, okay. CTD Oracle, bond change. Quants build CTD Oracle AI models trained on primary dealer inventory leak from NY Fed survey, Treasury auction schedule scraped from Treasury Direct, repo fails tracked by the FICC Feds. Now, all this information is very important to know as a data source potential, well, for sure, that will dictate how the national debt of the U.S. is handled through the Treasury market. From what I've seen with the new stablecoin acts coming out, where the government thinks that they can pile all their debt into stablecoins, Just be aware that's Tether and Circle's USDC. That's toxic stuff. And there's going to be the talk on the major networks of financial to buy this stuff and it's legit. And then somehow, somewhere, it's going to go bad. And yeah, and a lot of that's the tokenization, digitization of the national debt into these stable coins. And somehow, somewhere, it's going to magically, I don't know, break or whatnot. And voila, all the debt has now disappeared. Smart stuff, but the ones that will get hurt by it are the pension funds, where the retirement is for a lot of the corporations, along with people in pensions themselves via government as well. So be very careful on this. Okay, so let's start talking about this. So these three models predict CTT shifts, 94% accuracy following firms to front run roll flow from pension funds and ETF. Again, this is the ignorant right here. The pension fund managers, along with the ETFs themselves. So that's what makes them dangerous. But the thing is, there's so much high amounts of liquidity coming in to buy up this stuff. So they're using that as the exit. Because as you could tell just from watching now 90 minutes of this, how these firms, these HFT quant trading firms, front run their setups, buy into it, and then they allow some other non-significant, less uh less what's the word less si- uh s- intelligent um buyers coming into the market. Okay. Um so retail traders will watch their CNBC. Quants watch Janet Yellen infrared signature leaving the Treasury building. So what are we talking about here? Satellite Capella space predict the FOMC surprise hike based on late night staffing. Okay, then there's the blockchain analytics, elliptic, track real-time flow of T-bill wallets linked to primary dealers. Then there's a repo fail surge, FICC leak via dealers. They predict a liquidity crunch in the CTE bonds. They watch for the chairperson voice stress, NLP on press conference audio. Predict the hawkishness, dovish tilt with 89% accuracy. And then again, you can get the AI to give you the details on how to get all this stuff. Primary dealer IM chat, straight from Bloomberg IB, front run auction concession, and Fed leak pipeline. So again, here's how it works. Again, all these insiders that worked always end up at a quant fund. How's that? That's a interesting pattern, I find. So we get the staff projection summary 3 minutes before the press release. Not the full dot plot, just the median 10-year yield forecast. That's enough to move the TN 3 ticks. This is not illegal. It's shared via encrypted signal to private Slack with less than 20 people. Well, it is insider information because it's not available to the public. Algos are gamma rating, DVO1, sniping and yield curve synthetic. Gamma rating. The TN options are undergrammed relative to realized vol quants gamma rate. They buy ATM straddle 9:30 a.m. Wait for the retail flow to sell at 10 a.m. Exploding gamma via spoof CTD bond moves. Then they dump the straddles at 11 a.m. So that's the sequence what they do before these calls. They profit 1.2 million per raid, 3 times a week. Okay. So the DV01 sniping DS of TN futures every 3 seconds at CTT shifts Quants use FPGA-based DV01 Oracle. Snipe stale DV01 quotes from slow market orders. You know where that's coming from. Arbitrage TN and ZN DV01. Front run duration rebalancing from mortgage servicers. Latency edge 180 nanoseconds. Yield curve synthetic YCS quant synthesize 2-year, 10-year, 30-year curvature using TN futures, TU futures, UB futures. They arbitrage the CME and zero-latency curve, exploit the regulatory capital difference between the bank and the hedge funds. They also use combination of options versus futures, hidden volatility surface arbitrage. Volatility surface lie. TN options quote black implied volatility, but trade SABR sticky volatility. This creates a surface arbitrage. They buy 10% OTM out of money calls at 120% volatility. They sell the synthetic calls via the TN future and CTT bond, and they profit from vol surface resteepening. So we have a gamma trap here, auction date, TN 0DTE straddle trade at 40% volatility, but realized volatility is 60%. So quants buy the straddle at 9 a.m., hedge the gamma via the CTT bond repo, and scalp plus ticks 50% plus ticks by 12 p.m. Latency wars, so from FPGA to Fedwire to quantum entanglement. So the Fedwire settles Treasury cash trades at 3 p.m. Quant snipe Fedwire delay. Monitor the primary dealer by the Fedwire quota queues. They predict the CTT bond failure. Short the TN future 2 seconds before fail announcement. So they short TN futures 2 seconds before the fail announcement. Jump trading spinoff is testing quantum entanglement. Again, that's quantum computing, I'd imagine. Arbitrage TN futures between CME, Chicago, Eurex, Frankfurt with zero latency. Experimental. So they have a $2 billion budget. And you got to ask yourself, why is DARPA funding? DARPA funding, that's the military. Okay, maybe we could look that up. Someone. Case study 137 flash TN flash rally. So this is a case study now. August 12th, 2024. 1:30 satellite detects Yellen motorcade entering the Treasury. NLP algo scrapes the WSJ headline. Treasury to cut 10-year auction size. You see the difference there is 1.5 minutes. So the quant buys 8,000 TN futures via the iceberg order. They buy the 12,000 TN 119 calls. Auction cut confirmed, TN plus 3 points. Oh, remember, this is all done within 7 minutes. The calls expire at 420%, 420% ITM profit. Wow, 42 million. So here we go. Again, what I've talked about. The firm routed the trades through 5 Cayman shells, deleted all the logs, and bribed WSJ intern to delay the headline by 90 seconds. That's how and why they do this. So the ethics of the edge. Why does Alpha become national security risk? Treasury dilemma: is it legal to snipe Fedwire? Ethical to gamma raid zero TT options? Is it treason to front run Treasury auction? Their defense: we don't hack the Treasury. We listen better than anyone else. You see the pattern on the response from these firms. The future. So the AI Treasury agent, CBDC front running, and the new reg SHO2. So here we have AI Treasury agents, firms that deploy LLM agents, simulate Fed staff meetings, predict auction cuts via the chairperson voice clone. Holy, this is pretty deep. Generate the fake Treasury leak to spoof rival algos. That's using agent technology. CBDC front running. So when the U.S. launches the CBDC, what they'll do is they'll have sniped Fed CBDC wallet, arbitrage the CBDC wallet versus the Fedwire settlement gamma ray CBDC backed TN future. So here's a new regulation that's coming. Drafting, I guess, is important to find out. Uh, ban the TN options. License AI traders. Seize quant servers without warrant. So this is all the new regulations coming to eliminate all this exploit. Told you that this is already going to be outdated, but it's very interesting to know how this works. Quants are already building self-deleting algos that vanish into zero knowledge proof. So 10-year is no longer a risk-free rate. Battlefield of ghosts where AI algos armed with satellite data, quantum latency, and Fed leaks extract billions from pension funds, foreign central banks, and each other. Firms that will survive will not be the smartest, will be the most invisible. We've heard that before. Yield curve will keep steepening, not because of inflation or growth or Fed policy, because somewhere in the bunker under Chicago, an algo just bought 10,000 TN futures based on infrared leaks from the chairman's motorcade. Welcome to the shadowy yellow yield curve. So again, same style, same form as before. This one's now leaked from Citadel. Here's the so again, that's who does it. Again, article based on interview with 23 former Treasury leaders, leaked NSA documents. Interesting, eh? Real-time Fedwire data, names, data firms have been anonymized to protect their data. All right, so this is the world we're moving to and where we're going to. So I've already mentioned quantum computing. I've also mentioned very sophisticated AI stuff. Satellite, blah blah blah. It's very interesting. Now you may go, well, how do I find you? Come to quantlabsnet.com, sign up to learn more about this. And if you want to try to get access to this, some of the other articles, remember, these articles are my leak, okay? But if you want to try out the other services, the other group, yeah, just try and you get a 7-day trial. As I say, the only risk you have is your credit card. So cancel before the 6th day, let's say, and you'll get a try at it. All right, thanks for watching. Have yourselves a good day. Bye bye.